Trade with the market trend. When day trading individual stocks, many traders use the overall market, most commonly the SPDR S&P 500 ETF Trust, SP, as a directional filter. The idea is simple. Stocks tend to move more cleanly when aligned with the broader market trend. Using Fibonacci retracement levels on the market can help define whether conditions favor longs or shorts. First, consider the role of Fibonacci retracements. In an uptrend, shallow pullbacks that hold near the 38.2% retracement usually indicate strong momentum. Deeper pullbacks towards 61.8% suggest weakening trend strength. Traders often treat these levels as context rather than direct entry triggers. A practical framework: if the market pulls back only to the 38.2% retracement and holds, this is considered a shallow dip in a strong trend. Bias shifts toward going long on individual stocks. You then look for long setups, breakouts, pullbacks to VWAP, EMA bounces, in stocks showing relative strength versus the market. Avoid shorts unless the stock is unusually weak, if the market trades below the 61.8% retracement. This indicates deeper retracement and potential trend weakness. Bias shifts towards shorts. You prioritize short setups in stocks showing relative weakness. Longs become lower probability unless clear reversal signals appear. You also mentioned using current day versus previous day Fibonacci structure for confirmation. That adds a higher time frame trend filter. Stronger bullish condition. Current day price holds above previous day's key Fibonacci levels, especially 38.2%. Intraday pullback stays shallow. This indicates institutional buying pressure across sessions. Long trades tend to follow through better. Stronger bearish condition. Current day trades below previous day's deeper retracement levels, like 61.8%. Bounces fail at prior Fibonacci resistance. This suggests sustained selling pressure. Short trades become higher probability. Putting it together into a structured decision process: 1. Identify market direction using SPY trend, higher highs, lower lows. 2. Plot Fibonacci from the most recent impulsive move. 3. If price holds above 38.2%, maintain long bias. 4. If price breaks below 61.8%, switch to short bias. 5. Compare with previous day Fibonacci levels for confirmation. 6. Only take trades in stocks aligned with this bias. Example workflow: SPY opens strong and pulls back to 38%, holds. You look for long setups. You find a stock holding VWAP while SPY holds 38.2% long entry. SPY later breaks below 61.8%. You stop taking longs. Now you scan for weak stocks failing at resistance, short setups. This method improves performance because it aligns trades with institutional flow. It avoids fighting the overall market. It filters out low probability setups. It improves follow-through on momentum trades. Many traders combine this with relative strength, weakness versus SPY, VWAP positioning, 9 EMA, 20 EMA trend alignment, opening range breakouts, volume expansion confirmation. The key point is that Fibonacci levels on the market are not entry signals themselves. They define directional bias. Once bias is set, you execute on individual stocks that are behaving stronger or weaker than the market. Fibonacci retracements are a technical analysis tool used to estimate where price pullbacks may pause or reverse within a trend. The levels come from ratios derived from the Fibonacci number sequence: 0, 1, 1, 2, 5, 8, 13, 21, 34, where each number relates to the next. In trading, these ratios are projected onto a price move to identify potential support or resistance. The most commonly used Fibonacci retracement levels are 23.6%, 38.2%, 50%, 61.8%, and 78.6%. Each level represents how much of the prior move has been retraced. The 23.6% level is considered a very shallow retracement. When price only pulls back this little, it suggests extremely strong trend momentum. Buyers in an uptrend or sellers in a downtrend are stepping in quickly. This level is typically used in fast-moving markets. Breakouts often continue without reaching deeper retracements. The 38.2% level is still a shallow pullback, but more common than 23.6%. It signals a healthy trend with strong participation. Many traders treat a hold of 38.2% as confirmation of trend strength. If price bounces from here, continuation trades tend to have good probability. This level is often used for aggressive entries. The 50% level is not technically a Fibonacci ratio, but it is widely used because markets often retrace about half of a move before continuing. A pullback to 50% indicates moderate strength. The trend is still intact, but momentum is less strong than at 38.2%. This is often considered a balanced retracement. The 61.8% level is the most important Fibonacci ratio, often called the golden ratio. A retracement this deep suggests the trend is weakening, but not necessarily broken. Many reversals or strong continuation moves occur from this level. If price holds here, it can still continue in the original direction. If it breaks cleanly, trend failure becomes more likely. The 78.6% level is a deep retracement. When price reaches this level, the trend is close to invalidation. If the price reverses here, it often leads to strong moves. If price breaks beyond 78.6%, traders often expect a full retracement back to the starting point. How to draw Fibonacci retracements correctly depends on trend direction. In an uptrend, you draw from the swing low to the swing high. The tool will automatically project retracement levels downward. In a downtrend, you draw from the swing high to the swing low, projecting levels upward. The key is identifying the correct swing points. A swing high is a peak where price reversed downward. A swing low is a trough where price reversed upward. Many traders use the most recent impulsive move, especially when accompanied by strong volume or momentum. Example, in an uptrend, identify a strong move up. Draw from the lowest point before the move to the highest point. Watch how price behaves as it pulls back to each level. Look for continuation if support holds. Example, in a downtrend, identify a strong move down. Draw from the highest point to the lowest point. Watch retracement bounces. Look for shorts if resistance holds. How traders use these levels. Trend continuation entries. If price pulls back to 38.2% or 50% and shows support, traders enter in the direction of the trend. This is common in momentum trading. Reversal zones. The 61.8% and 78.6% levels are often watched for potential reversals, especially when combined with other indicators. Stop placement. Traders often place stops slightly beyond the next Fibonacci level. For example, if entering at 38.2%, a stop may go below 50% or 61.8%. Profit targets. Some traders use Fibonacci extensions for targets, but retracements can also guide partial exits. Confluence trading. Fibonacci works best when aligned with previous support resistance, VWAP, moving averages like 9 EMA or 20 EMA. Trend lines, volume spikes, opening range highs, lows. In day trading, shallow retracements, 23.6 to 38.2%, typically occur during strong trending days. Deeper retracements, 50 to 61.8%, appear during choppier markets. When price constantly breaks beyond 61.8%, it often indicates range-bound conditions rather than a trend. One important point is that Fibonacci levels are zones, not exact prices. Price may overshoot slightly and still respect the level. Traders usually look for reaction, not precise touches. A practical approach: identify the dominant trend. Draw Fibonacci on the latest strong move. Watch which level holds. Trade in the direction of the trend when support resistance confirms. Avoid trading in the middle between levels where probability is lower. Used properly, Fibonacci retracements help define market structure, trend strength, and likely pullback areas, especially when combined with overall market context, such as following the broader index. Following the market through the SPDR S&P 500 ETF Trust, SPY, is powerful in day trading because most U.S. stocks are highly correlated with the broader market. When institutional money flows into or out of the S&P 500, it affects liquidity, sentiment, and directional pressure across hundreds of stocks simultaneously. This creates a statistical edge when your trades align with the market direction rather than fighting it. The first advantage is correlation. Many large-cap and even mid-cap stocks move in the same direction as SPY. When SPY trends upward, buyers are active across sectors, making long setups more likely to follow through. When SPY trends downward, sellers dominate, and short setups tend to work better. Trading against SPY often results in weak follow-through or quick reversals. The second advantage is momentum confirmation. A breakout in an individual stock has a much higher probability of continuing if SPY is also breaking higher. If SPY is flat or falling, That same breakout often fails because broader market participation is missing. This is why traders frequently say the market decides. SPY acts as a confirmation layer. The third advantage is filtering low probability trades. If SPY is trending down, you can eliminate most long setups. This reduces overtrading and improves selectivity. Similarly, during strong bullish AY trends, you can ignore most short opportunities unless the stock shows extreme relative weakness. This filtering alone can significantly improve win rate. Another important factor is liquidity and institutional influence. SPY represents large institutional positioning. Hedge funds, mutual funds, and algorithmic strategies often move the entire market. Individual stocks rarely sustain moves against this pressure. Aligning with SPY means trading with institutional flow rather than against it. Relative strength and relative weakness become clearer when using SPY as a benchmark. If SPY is rising and a stock rises faster, that stock has relative strength and is often a strong long candidate. If SPY rises, but a stock stays flat or drops, that stock shows relative weakness and may be a good short candidate once SPY weakens. This comparative approach helps identify leaders and laggards. Timing entries also improves when watching SPY. For example, if SPY pulls back to a support level and begins bouncing, strong stocks often bounce simultaneously. Entering longs at that moment increases the chance of immediate movement. The same applies for shorts when SPY breaks support. SPY also helps interpret false signals. A stock may break support, but if SPY is strongly bullish, the breakdown often fails. Conversely, a stock may look weak, but if SPY accelerates upward, the stock may recover quickly. Without watching SPY, these moves can seem random. Another strength is intraday structure. SPY often sets the tone. Strong morning trend, continuation trades work. Choppy SPY range, breakout strategy struggle. Afternoon trend resumption, momentum returns. Understanding this context allows traders to adjust strategy rather than applying the same setup all day. Using SPY with Fibonacci retracements adds another layer. If SPY holds shallow retracements like 38.2%, it signals strong trend conditions. In that environment, aggressive continuation trades in strong stocks tend to work well. If SPY breaks deeper retracements like 61.8%, trend strength is weakening and shorts or mean reversion trades become more appropriate. Risk management also improves. If you enter a long trade and SPY suddenly breaks down, that's an early warning to reduce size or exit. You don't need to wait for your individual stock to fail. SPY becomes a real-time risk indicator. The overall benefits of following SPY: aligns trades with market direction, improves follow-through, filters weak setups, identifies relative strength weakness, provides timing cues, improves risk management, reduces randomness in price action. Many day traders treat SPY as the wind. Trading with it allows stocks to move more smoothly. Trading against it often requires perfect entries and quick exits because the broader market pressure works against the position.